There is.
Hello, good morning. Good morning to all of you. Let me welcome you all to this webinar on inflation outlook on behalf of CII. My name is Ajit Ranade and I head the subcommittee on economic affairs for the West Zone. This is a somewhat innovative session for us to share our thoughts about inflation outlook. I'm very happy to welcome Dr. Samiran Chakraborty, who's here with us and who's going to share his thoughts on the inflation outlook. He is the chief economist at the Standard Chartered Bank in India, and he's had a long and distinguished career as a very renowned economist in the field. So, without much ado, I'm going to hand it over to Dr. Samiran Chakraborty. But just a few ground rules. Um, this is a web stream, so there will be a Q&A. So you'll be able to see Dr. Chakraborty and you'll be able to ask him questions. As you know, the topic of inflation is uppermost in the minds of not just industry but also policymakers and the government. There is a feeling that perhaps later in this year inflation is going to taper down. There is a feeling that inflation is both coming from the demand side and supply side. But to hear more about it, let me hand it over to Dr. Chakraborty.
Thank you, Dr. Ranade. Good morning, everybody. It gives me great pleasure to address you in this innovative way. This is my first webinar, so different mode of communication. So I guess I will get used to it in a couple of minutes' time. I intend to speak for about 20-25 minutes at max, and then probably we can take questions that you might be having. Inflation is definitely top of everybody's mind at this juncture. So what I'm trying to do is a little bit talk about what might be causing inflation, then a little bit talk about where we are headed, and then on what kind of policy actions we can see going forward. So if you look at the trajectory of inflation over the last 15 years or so, it becomes quite obvious that, is this better now? It becomes quite obvious that 8% is on WPI is some kind of a alarming threshold for inflation. In the last 15 years, we've seen 4 episodes of more than 8% inflation. And quite interestingly, none of these episodes have lasted more than 6 months. So, in a sense, this particular episode of inflation is slightly odd because on WPI we have seen 8% plus inflation for more than 6 months now, and expected to stay above 6% for at least another 6 months or so. And if you look at CPI, then CPI is in double digits for more than 2 years now. So my first point is that inflation is clearly more persistent than earlier episodes of inflation that we have seen in India. Now, the second issue is that inflation is also becoming more pervasive. Pervasive in the sense that when this particular episode of inflation started, uh, we used to talk about food inflation. At some point of time in December, food inflation was as high as 20%, and non-food manufacturing kind of inflation, which sometimes we call it core inflation, that at that point of time was very low. At, for a prolonged period, it was very close to zero, even in negative. Now, that particular situation is changing very rapidly. So, food inflation from 20% in December has dropped to 10%, whereas non-food inflation from 0% has gone up by our estimate to about 9.5%. So while food inflation is dipping, non-food inflation is picking up. This is a particular pattern which one needs to observe very carefully and tackle very early. And we will come to more details about this non-food inflation in a while. But even within this non-food inflation category, uh, again, I'm making a little bit historical comparison here. In earlier episodes of inflation, generally 2 to 3 critical commodities they caused inflation. This time, inflation is almost in every commodity, every important commodity in the WPI basket. So, my second point is that inflation is becoming more pervasive, and a persistent and pervasive inflation is likely to be painful as well. So, across the board, I think consumers are feeling the pain of inflation, and our analysis shows that in high inflationary periods, the demand for consumer non-durables really suffered the most. So this time also we have seen that although industrial production growth has been often in excess of 10%, touching as high as even 17%, uh, industrial production, which has peaked at around 17% or so, uh, the non-durables, consumer non-durables, it has not even touched 8% in this whole episode, not even half the peak. So clearly, there is a lack of demand for consumer non-durables, and that could partly be because of inflationary pressures going through the economy. But a question often asked to me is that if inflation is so painful, why aren't we seeing street protests? Why aren't we seeing strikes? Why aren't we seeing governments being ousted from power? Uh, I think one interesting point somebody mentioned to me was that it could be that there is a difference between people being agitated or frustrated about inflation and that being channelized into a political movement. Uh, what might be happening today is that the frustration is there in the consumer's mind, but the political parties have not been able to channelize that into a street protest or ousting of the government. But if this continues for a while, even that channelization might also be possible. So clearly, that's one way of looking at this pain. The other way to look at this pain, which is a more economic way of looking at this, could be that this pain is not felt because income growth has been very rapid as well. Just to give you a perspective on this, per capita income in India, it took 33 years for India to move from $100 per capita to $500 per capita. And then it took just 5 years to move from $500 per capita to $1,000 per capita. So per capita income doubled in just 5 years. So income really has grown very fast. Now, what happened during the financial crisis was that India was one of the 3 countries in this world uh, which did not experience any fall in GDP. But stimulus measures in India were taken in large quantities, both fiscal and monetary stimulus. Often these stimulus measures were actually uh, pushed towards the rural India rather than the urban India. Now, this kind of redistribution of income and pumping of income into the economy through stimulus measures might have contributed to income growth across the spectrum and created demand for things, more particularly food grains. So, I'm not making a value judgment here that whether that's good or that's bad, but definitely this has been one of the demand components which Dr. Ranade was mentioning that has contributed to this kind of inflation. The other aspect which is very clear on food inflation is that to some extent last year's drought has definitely contributed to the food inflation, and that's probably the cyclical supply side issue that might have affected the near term supply side issue. But there are really a lot of structural supply side issues as well. And those issues relate to productivity growth in agriculture, logistics. We have all read headlines about how grains are rotting in different parts of the country. So clearly, that part also needs to be tackled, and that has also contributed to inflation. So it's a demand issue, a near-term cyclical issue of drought, and a slightly more longer-term structural issue of productivity, logistics, distribution, everything else. So this whole combination of things has most likely caused inflation, particularly food inflation, to flare up in India. Uh, Whereas the non-food inflation started moving up sometime in December, November, December, when it was becoming clear that India is undergoing a phase of almost a V-shaped recovery, especially in the industrial sector. So demand pressures were coming back into the system. As I was mentioning about per capita income, uh, per capita income growth stalled a little bit during the global financial crisis, but as soon as the backlash of the crisis was over, we started seeing labor markets getting tightened again, wage growth starting to happen, and that prompted uh, demand to come back into the system, which was further supported by both asset prices stabilizing and retail credit starting to pick up. So all these sort of contributed to demand growth, and I saw some fascinating numbers from a CII study which showed that in the June quarter, uh, for all the consumer durables that I could find, uh, be it cars, television, refrigerator, washing machine, microwave, everything was growing at between 30 to 50%, which is a stupendous growth in consumer durables that we have seen. And my hypothesis also is that part of this demand is actually because of a pent up demand. During the crisis period, probably consumption of all these goods dipped very drastically. People postponed their consumption, and now that consumption is hitting a peak. So all these meant that there were capacity constraints hitting particular industries, and those capacity constraints actually led to more pricing power in the hands of the producers, and that got reflected in higher prices as well. Now, this is probably a very early sign of wage price spiral coming back into the economy, where higher wages means that acceptance of inflation in the public domain is becoming relatively higher. Now that's where I am relatively I'm slightly contradicting the political scientist's thought that there is actually agitation against inflation which is not getting reflected in street protests. The economists would tend to think that there is the agitation itself is less because income growth has sort of quelled the inflationary pressures. So, uh, but it's a very interesting part to analyze that whether high inflation expectations is becoming very deeply entrenched in the public psyche or not. Because if that's the case, then structurally inflation is going to be higher in India for a longer period of time, and it will complicate monetary policy making uh, very much. So I think even RBI is worried about this particular aspect of inflation expectations really becoming inflation acceptance and inflation tolerance. And in my view, uh, most of the monetary policy action which is happening today is is to deal with this particular aspect of uh, trying to make inflation more a cyclical issue rather than a structural issue. Now, uh, till now, I was talking more about what is causing the inflation, the dynamics of inflation. Now, let me turn to where inflation is headed. Now, typically, RBI is uh, analyzing inflationary outlook from three perspectives. One is that the global economy is likely to look softer in second half of 2010 compared to the first half. So if global economy, be it US, China, Europe, or Japan, if it's softer in the second half, then the obvious corollary could be that commodity prices will not flare up in the second half. So with commodity prices stabilizing, maybe even tapering off, there is a possibility that it will have a rub-on effect on India's inflation as well, and inflation might also come down a little bit. Now, the second aspect that RBI is hoping is monsoon uh, has been quite good, so that should bring down food prices. Now, let me clarify a few things here. Uh, Overall rainfall has been more or less in line with what we expected in the beginning of the monsoon season. However, the distribution of rainfall, uh, I think I'm still not very comfortable with that. There have been pockets of the country which is facing drought-like situation, and there have been pockets where there have been excess rainfall. So there's still some time left in the monsoon season, uh, especially on rice. We have seen that the sown area has not been that good, but for most other cash crops, the sown area has been relatively good. We are yet to see the final outcome on uh, uh, oil seeds and soybean, uh, for which there are still some question marks left. But overall, it looks now that food prices will not be very much affected by monsoon this year. But this is a hope still that monsoon will bring down food prices drastically, and that will help inflation to cool off. The third thing is obviously RBI's own actions in terms of both raising interest rates and tightening liquidity. Now, this is something which uh, takes effect through a lag. We all know that monetary policy works with maybe anywhere between a 3 to 12-month lag. Now, my sense is that uh, it's actually the liquidity tightening which will have a larger effect on inflation than just interest rates. So if you analyze these three reasons, then it becomes quite clear that first two are really not in the control of RBI. It's only the third one which is in control in RBI's direct control. So we are still somewhat hoping that because of factors beyond our control, inflation will come down this time. Now, let me put down the trajectory a little bit here. And this trajectory is uh, clearly going to be determined by the famous or infamous base effect of inflation, because we are now talking year-over-year inflation. Since inflation last year shot up, this year, in an optical sense, inflation numbers will look lower. But they are not going to look lower till November at least. So till November, I would expect inflation to be hovering in excess of 8% or so. It's only post November that the base effect will start kicking in a relatively bigger way, and you could see by March end inflation numbers dipping to 6.5%. Now, uh, with this kind of a inflationary outlook, let's see what kind of policy responses we can get. So now, since bulk of the inflation is being caused by demand side forces, which is reflected in core inflation, it is quite obvious that the first line of defense would be the monetary policy. That's one of the reasons why you have seen RBI consistently raising both the repo rate and the reverse repo rate. Now, let me make some observations here. RBI hiking rates has really can do really nothing to the inflationary problem or the real economy unless this gets transmitted in the economy through a change in lending and deposit rates. So what we are observing today is that the lending and deposit rates are not moving in line with the policy rates. We thought that introduction of the base rate will make monetary policy transmission more effective, but it seems that base rate will have to stay in the system for some more time for it to become operationally effective. So that's the reason why RBI took this huge shift in stance on liquidity in July. So if you look at RBI statements from beginning July and end July, till beginning July, RBI was thinking of keeping comfortable liquidity in the system, even on the face of liquidity tightness followed by 3G auctions. But as the month progressed and we went into the July policy, it became clear that RBI wants liquidity to be tight in the system, because only in that case RBI believes that RBI's hiking rates would be passed on to the final users by the banks. Now that has happened a little bit, but newspaper reports suggest that banks are still unwilling to increase rates too much. This kind of rigidity in lending and deposit rates in the early part of the cycle is nothing new in India. It has happened in the past as well. But I think as the cycle progresses, this transmission mechanism will work better, and you will have some impact of these policies on inflation. The second part is obviously the fiscal policy. And in the initial days of food price inflation, you've seen quite active fiscal policy measures. As soon as the onus of inflation management shifted to RBI because of demand side pressures, I think government has played some kind of a hands-off approach from inflation. But to be very clear here, that the government still has a role to play. Over time, over a longer horizon, fiscal deficit is obviously one of the elements which causes demand pickup. As I was explaining earlier, the stimulus measures taken from the fiscal side, which redistributed income to the rural population, meant that there was a huge demand pressure on food. Now, keeping that in mind, I would have thought that this additional 3G money that the government had got of almost 70,000 crore, that could have been used that could have been used to bring down the deficit a little bit, rather than the current plan of spending it out almost entirely. That if government had reduced the fiscal deficit, then to some extent inflationary pressures might have been reduced. The other thing that the government will now have to do is probably the stimulus measures taken in the form of tax cuts, etc. those measures will slowly go out of the system, and that would mean that there could be some more price pressures coming from that side. The other aspect of fiscal policy, which has a direct implication on inflation, is the fuel price deregulation bit. RBI estimates that the direct and indirect effects of food price of fuel price deregulation is 290 basis points on inflation. That's 2.9%. We have at max seen half of this in the inflation numbers as yet. So when we are forecasting inflation, we should keep in mind that a large part of these indirect effects of fuel price deregulation is yet to hit the inflation numbers, and over the months you will see that hitting. So uh, that's something which is from a longer term perspective, it's probably a good thing to do, fuel price deregulation, but nearer term, this is going to put some further pressures on inflation. The third aspect of inflation management is RBI has mentioned that last year rupee appreciated by about 12% in a real effective sense. Uh, this rupee appreciation has brought down import costs, and to that extent, RBI estimates that about 1.9% reduction in inflation might have happened because of exchange rate appreciation. So going forward, I don't think RBI actively uses this as a tool, but if rupee appreciates as our expectation is, then to some extent that will quell pressures on inflation. But the most important aspect of inflation management is trying to address the structural supply side issue and the issue of inflation expectation and inflation acceptance. I don't think we have seen enough efforts going on towards these two directions. And I would personally want more action on these two fronts, which would ensure that inflation uh, is only a short-term phenomenon for India and does not have any long-term consequences. Let's not forget that in a world where everybody else is fearing deflation, if we are the country, we are the only country which is facing inflation, then very quickly our exports might become completely uncompetitive, and that might have long-term consequences as well. So we need to bring down inflation very quickly, and that should be one of our top priorities. I would like to stop here and welcome any questions from uh, the participants. Okay. Okay. Uh, uh, I have a few questions in front of me, and let me try answers to them. One is that whether the currency side actions from the central bank would have any significant impact on inflation or not. My sense is, as I was mentioning, that RBI will not take any proactive action to uh, tackle inflation through a rupee appreciation. But if capital flows in the latter half of the year or early next year actually makes rupee appreciate, RBI would not fight that rupee appreciation, as we have seen in the recent past that RBI has been more tolerant on both way rupee movement, and to that extent it can have some positive effect on inflation. There is another question on how will inflation look with the new WPI index. Um, New WPI index is still a mystery. Uh, it's a it's a mystery because we still don't know when it's going to come. The expectation is that from September it should come, but I haven't got any confirmation on that as yet. Uh, the difference that this new index is going to make is, to my mind, only the base year change. Uh, that would mean that weightage pattern on this index will be different from the earlier one and would be more realistic. Uh, the extension of inflation measurement from 440 commodities to 680 commodities, I don't think that's going to have a very big impact. I'm still worried that the measurement of prices would remain by the same process as was earlier. So if we had any question marks on these huge revisions of inflation that's happening nowadays of more than 1% often, those kind of huge revisions are still going to remain in the system. There's a question on capacity additions and whether bank credit numbers are suggesting so. Now, bank credit numbers have been slightly distorted this year because of uh, exceptional credit given to telecom companies for their 3G auctions. So it's quite possible that uh, there is if you adjust for that, uh, as yet bank credit is only getting disbursed for mostly infrastructure companies. If you analyze it, then more than 40% of bank credit is bank credit for industry is going towards infrastructure sector, which is very high. So my basic point is that economic growth per se is not happening everywhere in the country. It's happening only in some parts of capital intensive industries, not really too much on the labor intensive side. Capacity additions are happening, but my sense is that it should be happening at a faster pace. What is Standard Chartered's inflation forecast for fiscal year 11? Our forecast on WPI is that it's going to be an average of 8.2% for the full year, year ending at around 6 to 6.5%. Um, Diesel deregulation and its impact on inflation? No, not too much. It's about a 1 to 2 rupee diesel price increase would mean, by my rough calculation, I'm just thinking on my head here, it would be about 20 to 30 basis points, not really a very big change. Um, Okay, this is a very good question on uh, uh, this is a very good question on and I missed this point. Uh, when we look at inflation numbers coming down in a year-over-year sense, uh, we are we don't often uh, appreciate that this is because of the base year. So if we are taking out the base year, then how does inflation look like? Now, we do our own seasonal adjustment calculations and then check for month-on-month numbers. And typically, we have seen in earlier times that first the month-on-month numbers start falling, and then the year-over-year numbers start falling. So month-on-month numbers, in our view, is in some kind a leading indicator of the year-over-year number falling. Now, thankfully, over the last 4 months or so, we are seeing the seasonally adjusted month-of-month numbers falling to some extent. And that's something which is comforting and is giving us hope that our trajectory on inflation that we have, uh, uh, that trajectory will actually materialize over the next few months. I have a question on my estimates of uh, dollar versus INR for 2011. Now, I don't know how it's connected to inflation, but still I'm going to answer that. Uh, we think that near term it's going to be very choppy and could be some depreciation pressures on rupee. And that's going to arise mostly because of the huge trade deficit that we are running. Now, let's analyze this trade deficit a little bit because this has some connection with inflation. My hypothesis is that we are seeing a huge spurt in non-oil imports, much more than what is justified by the capex recovery or industrial production numbers that we are seeing today. So my hypothesis is that since most of the other countries are going through a deflationary episode while India is going through an inflationary episode, uh, Indian producers might be tempted to import more just because of cost advantage. And that might have fueled a huge import boom. And this kind of monthly run rate of $10 to $12 billion of trade deficit has meant that rupee has remained weak, although we are still getting a lot of capital flows. FII flows for both July and August have been quite good. Our sense is as the year progresses and our global view is that both US and China, they are going to put further stimulus into the system going ahead in Q4 and Q1 of 2011. If that happens, then the risk on trades will start back again and money will start flowing into emerging markets. And that's the time rupee will start appreciating. And we feel that on a trajectory basis from then on an appreciation path, probably around 44, 44 half by March 2011. That's what we are looking at. Question on why are food prices up when there's so much food stock. This is obviously analyzed very nicely in the economic survey of this year. What's happening is partly that you are having this situation where when you are using this PDS to distribute food, there are inherent problems of this PDS. One of the problems is that you are auctioning these grains in big lots. So whoever is getting these lots are then selling it in some kind of a oligopolistic fashion, which is keeping prices higher. So one of the suggestions given is that do these auctions in very smaller lots to lot many people so that this kind of oligopolistic pressures are not there. So the other part is that, as I was mentioning, that the logistics problem and distribution problem is something which I feel that we haven't done enough about, and even in the next foreseeable future, I see more food stocks being wasted, and that's the reason why I feel ashamed that we haven't done enough on this. Impact of inflation on loan products in coming years. This is a question. Impact of inflation on loan products would typically, in my view, come through the interest rate channel. So depending upon the trajectory of inflation, RBI will calibrate its own monetary normalization process. Our sense is that if we were projecting about 8.5% GDP growth and about 6% inflation by year end, which is RBI's projection. Then the so-called neutral rate of inflation, neutral rate of interest is about 6.5%. So we think that about 50 to 75 basis points of rate hikes over the course of the year is quite possible. So the bigger question is that how much of these interest rate hikes will actually be passed on by banks going forward? And there are clearly no good answers to that. It will depend upon how tight liquidity is in the system. Our sense is that liquidity, although currently it's relatively easy, it's not going to be easy throughout the year. So there will be brief periods of liquidity tightening, and that will further push up interest on these loan products. This is a tough one. Customers are pushing for price reduction as volume orders are increasing, but suppliers are asking for price increases due to inflation. This is an absolute microeconomics one situation where you are essentially talking about a bargaining process of determining the exact price, right? So customers will always want a lower price and producers will always want a higher price. Uh, so the market will clear at the price where both are agreeable to buy and sell. There is no particular way that I can think of in terms of handling this situation other than referring to Adam Smith's invisible hand, which at some point of time will work. And the other thing that's going to happen is that again it will be an issue of bargaining where whoever has the bargaining power will win. So in an industry where there are capacity constraints and suppliers have the upper hand in terms of pricing power, uh, the price would mostly shift towards their end. And in an industry where there is probably excess capacity, prices will more shift towards the customer's end. I don't think that I can give a more generic answer than that. Uh, Inflation pressure and its impact on GDP, yes, there could be some impact, especially through the consumption channel. We are already seeing that consumer non-durables growth is not happening. And if you would recall, consumer non-durables is almost 5 times consumer durables in our IIP calculation, and IIP directly goes into GDP calculation. So if consumer non-durables are impacted because of inflation, then GDP might also be impacted. Uh, Although we might, in our day-to-day experience, find that malls are becoming more busy these days. We don't get parking anymore, but actual GDP numbers show that consumption growth is just 2.6% in the last GDP print, which is almost a historical low. So that could just be because that consumer non-durable consumption is not happening at a pace uh, that's that can be spoken of. If there are no more questions, then I would like to thank all of you for your patient hearing and all the questions from your side. It was really nice interacting with all of you. And thank you, CII, for giving me this opportunity. Thank you.